What's up guys, Nam here. In today's video, I'll show you exactly how to invest inside index funds. Warren Buffett, the investment god himself, wrote in his will that the trustee is to invest 90% inside of the S&P 500 index fund and 10% in short-term government bonds. When one of the richest men in the world gives you advice about investing, it's probably a good idea to have a listen. So if this sounds like you, then you came to the right place. I'm gonna go through the exact details of what an index fund is, why you should invest into index funds, and my own personal recommendations of how to get started. First off, what exactly is an index fund? An index fund, in the simplest sense, is a collection of stocks. And what a stock is a small piece of a company. When you buy a share or stock of Apple, you own a small piece of the company, and you will get exposure to the growth and the downside. Since index funds are a collection of stocks, they typically track movements and performances of a segment of the whole stock market. For example, the S&P 500 is probably the most well-known index that tracks the performance of the largest 500 publicly traded companies inside of the US. Some other big indexes are the Nasdaq 100 and the Russell 2000. Each one of these track different parts of the stock market, and the stocks within these funds are different. Index funds are typically used as a baseline comparison. If you want to make an effort to trade stocks or develop your own portfolio, you want to make sure that you're able to beat a specific index. The index that gets compared the most is the S&P 500. Most people, they refer to this index as the market. So imagine that you're trying to get into fitness and you want to try to find the best ways to build your legs. There are so many different types of variations of different types of leg exercises, such as machines, squats, lunges, and so many more. So if you wanted to build muscle and strength, probably the basic exercise that you probably should be doing is squats. Doing squats is a compound exercise, which means that it works all different types of muscles. And there has been numerous studies that show that when you do exercises that consist of multiple muscles, in general, you gain more strength and muscle mass rather than doing isolating exercises. So imagine that the S&P 500 is equivalent to squats. In a way, just this one exercise will give you the most gains. You see what I did there? Leg gains, investment gains. Even though the majority of people's portfolios should just consist of index funds, you can always set aside a small percentage of your whole portfolio for more risky investments. Me personally, I do trade stocks time to time, but it's usually a smaller portion of my portfolio as a whole. These are the main reasons why you should invest this way. The first one being is that index funds are typically very low cost. So whenever you want to invest into an index fund, you cannot invest into it directly, but you usually have to buy an ETF, which is an exchange traded fund, or invest into a mutual fund. ETFs, they're treated usually like stocks, and you can buy them on any type of stock trading platform. On the other hand, mutual funds are usually provided by bigger investment companies such as Vanguard or Fidelity. Either way, all ETFs or mutual funds have this thing called expense ratios. So in a nutshell, it is a percentage cost of assets that you invest in. So for example, if you invested $1,000 in an ETF that has an expense ratio of 0.1%, for every $1 that you invest in, it will cost you $1 per year just to own it. On the other hand, if you decide to invest into an actively managed fund, such as many mutual funds, they have expense ratios anywhere between 1 to 2%. The reason why they are much higher is that they have portfolio managers who picks the stocks and they determine when to buy and to sell. If you really think about it, if you were to invest into a mutual fund that has a 2% expense ratio, it can cost you a lot of money in the long term. For example, if you were to open up a Roth IRA and you were to max this out for the next 35 years, with an average return of 10% minus an expense ratio of 0.1%, your yearly return would be 9.9%. After 35 years, you would have a stockpile of $1.7 million. On the other hand, if you were to invest into an actively managed mutual fund that gets a return of 10% but charges a 2% fee, that minor difference can cost you $600,000. That is not chump change by any means. Expense ratios are that hidden fee that messes everything up. By the time you realize it, it's too late. It's like whenever you go to a hotel and they charge you a resort fee. You spend all this time planning, traveling there, and when you check in, the receptionist says, there's a $40 daily resort fee. Like seriously, sometimes it costs you about the same cost as the room, but you're there already and you just suck it up. That is how expense ratio screws you over in the end. On a topic of lower costs, you generally pay less taxes. Index funds, they are very tax efficient compared to many other forms of investments. For example, index funds typically don't buy and sell holdings all that much compared to actively managed funds. This way, index funds avoid generating capital gains, which can definitely add to your tax bill if you're making a bunch of trades in 1 year. Because if you buy and sell a stock that you hold less than 1 year, you would have to pay a capital gains tax, which is your current tax rate. So if you're making $50,000 a year and your federal income tax rate is 22%, that's how much you would have to pay on your gains. But if you were to hold for any type of stock for more than 1 year, you would just only have to pay 15% for long-term capital gains. Just like federal tax rates, there are different brackets for long-term capital gains. Depending on how much you make, it can be as low as 0% or all the way up to 20%. Not too long ago, Warren Buffett, he made a $1 million bet for hedge fund managers to outperform the S&P 500 over the course of 10 years. Long story short, Warren Buffett won. Even over the course of 5 years, only 23% of actively managed mutual funds can outperform the S&P 500. According to a research report from Standard & Poor's, they reported that actively managed funds hardly ever beat a simple index fund. They found out less than 5% of actively managed funds can outperform the S&P 500. Generally, index funds, they have high returns and low costs, which makes them an excellent value for investors who are trying to keep expenses low and profits high, which should be most people anyways. One of the key benefits of investing into index funds is that your portfolio becomes very well diversified, which means that it minimizes your chance of losing money. For example, when you buy a bag of Jelly Bellies with a whole bunch of different type of flavors, whenever you come across the popcorn flavor, you just toss it out. I'm just kidding. Eat it anyways. I don't like to be wasteful. But you guys get my analogy. When you invest into index funds, there's going to be some stocks that won't perform that well. So instead of putting all of your risk into a few stocks, you put your money in a whole bunch of different ones. It's like that old cliche saying, you don't want to put all of your eggs in one basket. This diversification has your money spread amongst all different types of companies, so the volatility is much smaller. Simplicity is probably the reason why you want to invest into index funds. There is no easier method than investing this way. This minimizes your time spent researching individual stocks, reading income statements, doing fundamental and technical analysis for every individual investment. Imagine why you buy stuff off Amazon. They make it so darn easy. With a click of a buy now button, you can automatically get something shipped to your front door in 2 days. That's how easy it is to start investing into index funds. In most cases, if you are investing into these type of funds, you usually have some automatic investment going on a regular basis. Again, this makes you not have to think so much about investing, but you know for sure you're gonna get some great gains in the future. So enough of me selling you the point of investing into index funds. Now let's talk about how to exactly invest into index funds. There are actually plenty of ways that you can actually do this. If you're currently working for an employer who does fund your retirement account, more times than not, you will be already invested into some sort of index fund. For example, a previous employer of mine, they were investing into a retirement fund on our behalf using Fidelity. There was a long list of different types of funds that we can invest into. The more common ones that you do see for retirement are age-based retirement funds, meaning that if you are planning to retire in 2050, your holdings in that portfolio would change with your age. As the older that you get, your portfolio becomes less and less aggressive, meaning that your exposure to the stock market becomes less and your investment becomes more stable with bonds. So double check with your employer's investment firm first, just to see what are your options for investing to index funds. But if you don't have an employer provided retirement account, you can actually do this yourself. Probably the easiest and simplest way to invest into index funds is using an online broker such as Fidelity, Charles Schwab, or Vanguard. All of these brokers have mobile apps as well, but if you're a young investor and you like to have things a little bit more simpler, I do recommend using apps such as Robinhood, M1 Finance, or Webull. I personally use M1 Finance and Webull. I do have some referral links in the description below if you guys want to check them out. If you do decide to sign up for Webull, you can get 2 free stocks, one when you sign up and one when you deposit $100. Each one of these stocks can be valued up to $1,400 a piece. So before I start listing off all the ETFs that I do recommend, I gotta put this disclaimer out there that this is not financial advice, and always do your own research before investing into anything. So with that out of the way, let me start telling you which ETFs I suggest. So the first one is gonna be VOO. This is a Vanguard ETF that mirrors the S&P 500 index. The S&P 500 is what we all probably know to be the most popular index fund that most people compare their investments to. At the making of this video, this ETF will cost around $290 per share. This ETF has an expense ratio of 0.3%, meaning that for every $1,000 that you do invest, it will cost you 30 cents. Which means that this is one of the cheapest ETFs that you can invest into. Even though the Vanguard website did not provide a 10-year return for this ETF, it does mirror the S&P 500, and a 10-year return for that specific index is 13.15%. The second one that we'll be talking about will be VGT, which is the Vanguard Information Technology ETF. This one is one of my other faves because it mirrors a benchmark index that emulates the best stocks inside of the tech sector. Investing into one sector is more of a higher risk, high reward type of investment, just due to the fact that you're leaving more of your eggs into one basket, but the gains are so much greater. The majority of the holdings in this ETF is Apple, Microsoft, Visa, Intel, and MasterCard. At the making of this video, a share costs roughly around $270 per share. This index fund still has a relatively low expense ratio, coming in at 0.1%. The performance for this ETF in the past 10 years is 18.7%. So the next ETF that we will be talking about will be QQQ, which is Invesco QQQ. So for this particular ETF, this one tracks the NASDAQ 100 index. So for this index, it consists of all different types of stocks, but it's very tech heavy and it also includes stocks in communication services, consumer goods, and healthcare. So at the making of this video, QQQ is roughly around $240. This one has a little bit of a higher expense ratio compared to the other two. It has an expense ratio of 0.2%, meaning that if you were to invest $1,000, it will cost you $2 every single year. Another reason why I do recommend this particular ETF is that it has a very strong performance history. Within the past 10 years, QQQ had a return of 17.32%, which outperforms the S&P 500. So the next one will be the Vanguard Total Bond Market ETF, which is BND. While there are a bunch of different types of bonds that you can invest in, such as corporate bonds, municipal bonds, and US Treasury bonds, this particular ETF is a well diversified in all different types of bonds. So it's a type of fund that's very basic, like vanilla. At the making of this video, BND is roughly around $90. So as with most Vanguard ETFs, they have really low expense ratios, and this one is no different. It has an expense ratio of 0.035%, meaning that if you were to invest $1,000, it will cost you 35 cents a year to own. Investing into bonds are typically a safer type of investment because they usually have less risk and lower reward. Within the past 10 years, this particular ETF has returned roughly around 3.86%, which is nothing to be super impressed about, but when you build a simple portfolio, it is nice to have a balance between equities, which are like stocks, and something much safer, such as bonds. So going back to that letter given by Warren Buffett, he told his trustee to invest 90% into stocks and 10% into short-term bonds. If you wanted to build this exact portfolio, all you would have to put is 90% of your money into VOO, which is an ETF that mirrors the S&P 500, and 10% of your money into BSV, which is a short-term US bond ETF. There are literally hundreds and thousands of possibilities in building a portfolio and how you want to diversify your ETFs. So as long as you have your goals in mind, having an investment strategy that correlates with your goals can be much simpler when investing into simple index funds. Alright guys, so that pretty much does it for me. Let me know in the comments below if you guys invest into index funds, and if you haven't already, make sure you give this video a like because that really helps support the channel. Subscribe so you don't miss out on any future videos, and if you want to hang out with me some more, check out my videos over here.